Hello, everybody. Welcome to the Family Firm conference call, version February 2018. This is Nathan Gendelman, the President and Director of Investments at the Family Firm. And Stephen Daly's here as well, helping me with technology and questions I don't know the answer to. So for today's call, I wouldn't really describe the substance of it as downbeat. Not at all. I kind of prefer to call it a reality check. And since it is based in reality, it has both positive and negative connotations. Well, here we are, February 28th, 2018. So we had a down day in the market today and a down month, February. And that's what happens. And actually, it's interesting to think, well, what is the anomaly here? Because true, this month was down by roughly 4%, but that followed a period in which the stock market had gone up for 15 straight months. So that's really the anomaly. And actually, if you do some kind of really elementary statistical calculation on that, really the market should only go 15 months in a row. 0.2% of the time is kind of how you would maybe do a calculation of that. So very much an anomaly for things to only go up every month. And so to go down is actually, it happens. The other thing that we've heard a lot about over these past, the fact that the market went from peak to, when it hit a low, had a double-digit decline. And we had a lot of hand-wringing about that. And, it's true, we never like it. It always feels very painful when it happens. And yet a 10% decline within a year is actually normal. That's the expected. It's the anomaly is when it doesn't happen. And it's roughly 2 out of every 3 years where there's a decline of that magnitude during the year. So it kind of puts into perspective what we've gone through for these past, 4 to 6 weeks. Another thing that's just been going on too, and again, I'll leave it really to you all to decide what's the anomaly, but there's been quite a few big moves in the markets, big just defined as 1% or more in either direction. It seems like there's been quite a few this year, and for sure there have been. And it's kind of interesting, when we look back at 2017, there were only 8 days in the entire year where there was a % move up or down. Very low. And this year, yes, we're already about twice as many days as it happened all of last year, maybe a little bit higher than normal. But it was really last year that was the anomaly, and just the almost incredible tranquility in the markets. And to be experiencing up and downs like we have just this past week is actually more the norm than the exception, as uncomfortable it is as it can be, for sure. So I just wanted to share just kind of those, what I kind of described as the reality check. And I'm anticipating there'll be some questions just about what's going on over these past few weeks. But I wanted to just share a couple of other nuggets, if you will, that again, I would describe in the reality check realm. So one I saw that I just read in the Wall Street Journal this week, I thought was really fascinating. They looked back at the rally in stock prices that there's been since 2009, which in rough terms, they've roughly quadrupled since then, since the low in March of 2009. And they tried to ascribe, well, what has been driving that increase? Has it been profits? Has it been valuation? Which those are about the only 2 things that it really can be. And, the good news, I guess, is that, hey, profits have really soared since 2009. They've actually doubled in 8+ years, which is pretty remarkable. And that's great, but that's okay. But the stock market has gone up by 4, and profits have only doubled. And really, so what the rest of it is just an increase in this price to earnings ratio, just what they call valuation. And I think when we kind of strip away a finance lingo from that, it really can just be, to me, is defined as optimism. That's what price to earnings ratio is. is how optimistic investors are. So kind of trying to rephrase that again. So quadrupling since 2009, a little bit more than half due to profits, and the other half due to optimism about the future. That's the reality. It would probably be a little bit more encouraging if it was all profits and less optimism, or if there was some pessimism thrown in there. But I do think, that definitely gives one a little bit of pause as we sit here now in 2018 with so much optimism being reflected in the value of stocks. So one other nuggets that I just wanted to share is just kind of about the overall economy. I don't think there's much disagreement that the economy is doing fairly well. Although I guess I would maybe have my own caveat that I would say maybe a little too much complacency and sometimes borderline giddiness about the American economy that grew just only about 2.5% last year. Not spectacular, but certainly it's doing fairly well. What should give pause, and at least gives us some pause, is that this moderate rate of growth is really being supported by a lot of borrowing and temporary factors. So one of which has been a really large drop in the personal savings rate, which actually is down at a 12-year low. We can only spend down our savings so much. And that's there's some other sort of indications of how much debt is being taken on in the economy. You look at margin debt that investors have on their brokerage accounts, that's at a record high. Corporate borrowings, whether to buy back stock or to just for other purposes, that's at extremely high levels. And what we've certainly seen over these past 2 to 3 months is that it's not just individuals and corporations who are cutting back on their savings, but the government has really launched a big dis-saving program with just kind of astonishing levels of deficits, which are wonderful if we're looking at supportive of economic activity just for today. But there's really no escaping paying back those bills. And those bills of all the deficit spending, they do come due, and they just end up weighing on the economy whenever those debts are paid. And I kind of been sitting here looking at things in Washington over these past couple of months and just sort of wish that someone would remind the White House and Congress that this law hasn't been repealed, that we have to repay the debts, and that weighs on the economic performance when the bills come due. So I'd like to thank everyone for listening to all that, and I would love to hear what's on your mind, and if there are any questions or anything I can elaborate on, I'd be thrilled. All right, well, I did receive one question via email, so I'll answer that, and then we'll see if anybody has anything that they'd like to contribute or any thoughts that anyone might have. But someone asked basically how we think about the reallocation decisions, and in particular, purchasing more stock at a certain point and what the thinking was on that. Really, because we do manage all of our clients as individuals, we try to look at that on a client-by-client basis and seeing if, what makes sense. Does it make sense to buy stocks now? Did it make sense a week ago? What's the context of their overall risk profile, where things are, for them? Now, obviously, if there's a really huge move in the markets, one way or the other, we would look at things on a more macro level and say, no matter what someone's circumstances are, if there's a huge increase or decline in the market that really necessitates a careful look and probably some action. I would say that what we've seen over these in January was a pretty healthy increase, February a healthy decrease, really has not warranted that kind of macro change. But you know, I hope it doesn't happen, but it inevitably will. Will there be a really huge move up or down? We take a look across all the clients. What often complicates that decision making a little bit is when there's so much volatility within a day or within a couple of days. So for instance, today where there was a whatever 350, 400 point decline, it really only happened within the last hour or so of the day. And so that really, so a decision that looked like it made a lot of sense at 1 p.m. might have ended up not making sense at 4 p.m. And that's one of the tricky aspects when things are bouncing around quite a bit within a day or within a week of, you know, trying to make a decision that makes sense for the future. But that's something, you know, we do our best. And in general, obviously, things don't move by 300 points in an afternoon very often, thank goodness.
So Nate, just wondering if you could talk a little bit about the pressure on interest rates. Do we have pressure on interest rates? How bad is it? And whether this deficit will, when that will, you know, sort of rear its head on interest rates?
Yeah, thanks, Mary. It's a great question. And definitely over the past few months, certainly the interest rates have gone up. The Fed, I guess, increased rates once by 1/4 point, and the mortgage rates and the longer term rates have maybe gone up by 1/2 point since then, which maybe isn't that much if you say, well, we've got an economy with almost full employment, a huge tax cut, and a lot of spending coming in, that, well, maybe actually rates should have gone up more. But honestly, the truth is that this inflation, although it might happen and that might pressure the interest rates, it really hasn't materialized yet. And, you know, some of the things even that are happening with the, as I mentioned, the mortgage rates having gone up, that's, they're doing a pretty good job of holding down the housing market, which is can be a big driver of inflation, and sales have been pretty flat since the rates have started to go up, and that kind of suppresses things a little bit. You know, obviously we'll just have to see where if actually some of these inflation fears or concerns begin to manifest themselves in the statistics. It certainly seems like they would, based on what's happened in the past. But, you know, every time is different. And so far, to be honest, with really, it's been true for the past couple of years, very low unemployment and a pretty scarce job market for skilled people that really has not expressed itself in economic data and necessitated the Fed to take really drastic action that would scare the bond investors and push interest rates up pretty high. The other thing that's kind of holding the interest rates down, I'm sorry if I'm elaborating too much on this, but just what's kind of holding interest rates down here is that interest rates are very low in Europe and Japan, and those are manipulated by the government, really, as our own are as well. But they're being held at extremely low levels, and it's hard just in a global marketplace for the American rates to get too high, too detached from what's happening in the rest of the world, because buyers just keep coming in and purchasing them and suppressing the yields. So it's definitely been hard to talk about interest rates in a world where they're just being so completely manipulated by the governments. And my personal wish is that would diminish some, but it doesn't seem very likely.
So you might say that, you know, sort of this not aggressive interest rate move would be a support to a raging stock market, wouldn't it?
Oh yes, for sure. I mean, if the perception came in that inflation was out of control and that interest rates would have to rise drastically to cut things off, that would be a pretty dire scenario. And that was originally what was the reason that was that the stock market decline in early February was ascribed to, that people were worried that inflation was about to emerge out of nowhere. And again, maybe there's worries about it, but it hasn't expressed itself in the data yet.
Thanks.
Thanks, Mary.
I have a question. This is Andrew. Looking forward at, for example, the negotiations over Brexit and also the Department of Commerce gradually ticking up in terms of potential tariffs with Canada and with China. Are you concerned at all that there may be disruptions of trade, or is it just too small to really affect the overall stock market?
Well, so far, thank goodness it's been too small. And it seems like some of the things are just being done more of a grandstanding gesture than really something that would cut into the meat of trade. But as we know from Washington and even throughout the world, as you mentioned, Brexit as well, sometimes it's hard to put too much faith in rationality of some of the decision makers. But honestly, so far it's been just things nibbling on the edges of the economy, solar panels and washing machines. And I guess we'll have to see about some of the more substantive things. But you're definitely right. It's a scary thing that could happen. It hasn't yet, but that's no guarantee about the future. And I think I would say, because I think we should all be supportive of free trade and things like that, that we've probably had a much easier ride in 2017 and through these first couple of months in 2018 than it seemed like was headed our way after the elections.
Thank you.
Thanks, Andrew.
Nate, a broader question. The family firm has always preached diversity in our portfolios as a way to protect ourselves against volatility. Do you see any potential scenarios on the horizon where that would not work, where everything would go down the tubes and we should, start buying gold or putting our money under our mattresses or something?
Well, I was actually just commenting to Steve how we have really been in a fortunate environment where the bonds and stocks have really been moving in a different direction, showing a good negative correlation, which means, where one does well, the other one doesn't. For really actually since I started here at the family firm in 2001. Obviously, there's no guarantee that would keep going. That has really been the linchpin of our diversification. The scenario under which that is tripped up is the runaway inflation scenario that sort of happened in the late 60s and through some of the years of the 70s. In those cases, some of the investments that are in portfolios now did respond, and I'm optimistic would respond. The things that are more inflation sensitive, sort of like the natural resource or the energy type investments, real estate, things like that, the inflation protected bonds, obviously, which really didn't exist back then, that are available now. But it would be a more difficult time than we've gotten used to over these past years, for sure. But, we haven't, outside of making sure that we always have things that are sensitive to inflation, you know, we haven't overemphasized them in the portfolios because, you know, really there hasn't really been inflation. And again, although some of the trends in the world might be slowly shifting, there's a long way to go yet until we really have an inflationary environment. And just the world is so different now in terms of how labor works and mechanization of jobs and the de-emphasis on commodities and natural resources. That, you know, obviously we always have to be alert. We always want to make sure we're protected against all different kinds of scenarios. But the sort of runaway inflation where a lot of things are linked to the consumer price index, especially the cost of, you know, wages and things like that, not a very big risk factor right now, just to be honest. Okay, well, thank you everyone for your attention and for those great questions. What we will do is we're actually recording a call now, and we will place it up on the website, and we'll send an email around with an attachment to the link. If anyone wants to follow us on more of a real-time basis, I have my LinkedIn account, and the family firm has a Facebook account where I try to post some of these thoughts on a more timely basis, and you're all welcome to follow and share your thoughts on those media as well. So with that, thank you everyone, and have a great evening, and we'll be in touch soon.
Thank you, Nathan.
Thanks, Nate.
Thank you.
Thank you. Thank you.